So today's event is going to focus on stories from the trenches, SPAC and IPO readiness, and we'll be featuring speakers Michael Green, Anthony Leung, Don DePascal, and Christian Kelly. Our moderator today is Michael Green, CPA, partner for Baker Tilly. Michael currently leads the Baker Tilly Life Sciences industry practice and oversees life sciences advisory, tax, and audit. He is an audit partner with decades of public accounting and life sciences private industry experience. Please take it away, Michael.
Thank you. I'd like to introduce our three panelists this morning and welcome everyone. First of all, Anthony Leung. Anthony's a partner at Baker Tilly. He has over 25 years of experience serving both public and private companies. He leads numerous financial statement audits, risk assessments, compilations in multiple industries, and is one of my co-partners in our life science practice. So thank you, Anthony. Next up, we have Don DePascal, who is also a CPA. He's the technical VP at Murdoch Martell. Don is a finance and accounting expert. He specializes in SEC reporting across numerous industries, including IPOs, governance, expert in preferred stock financing, due diligence, and financial aspects of mergers and acquisitions. Pleased to have Don on the panel today. Next up, we have Christian Kelly. Christian's a certified information security professional with over 22 years of experience. He's the CTO at Xantrion. He is responsible for ensuring the availability and security of client systems, as well as making sure that they conform to regulatory requirements. What you'll hear is a very important function in the going public process. And Christian has over 10 years experience dealing with companies, including life science companies. So with that, I'd like to kick things off and go to our first panelist, Anthony Leung.
Thanks, Mike. Good morning, good afternoon, or good evening, depending on where you are. My name is Anthony Leung, audit partner with Baker Tilly. I'm pleased to be here sharing my experience with SPAC transactions, so the special purpose acquisition companies, or SPACs, which is actually not a new thing. It's been around for a long time. It has certainly gained a lot of popularity over the past few years. In fact, it's actually the most common way to become a public company these days. Despite all these increasing scrutiny by the regulators, which actually resulted in some legal settlements recently, SPAC certainly continues to be a very, very popular way to for companies to become public companies. If these transactions are done right, or structured right, they could be a very good alternative for a private company to go public, especially for life science companies, because traditionally investors in life science companies, they place less focus on the historical data of these companies. So this line is actually a very, very typical structure of a SPAC offering. So there are four groups here. On the left is the management group. So these are usually investors. These are usually former industry executives. They could be institutional investors or private equity firms. And in this example, they put in $25,000 and receive common shares of the SPAC company, which is the public company. And the management team also put in like $4.5 million here. And receive warrants. $4.5 million is really used to fund the operations of this SPAC from inception till the completion of the transaction. The SPAC company will then go to IPO, will file usually an S1 with the SEC. And in this example, it raised $100 million. And the public shareholders on the top, they ended up owning 80% interests in the SPAC company. The $100 million will be deposited into independent trust, which is at the bottom of the slide. The public shareholders have the option or have the right to ask for the money back in case they don't like the target companies identified by the SPAC company on a later date. And usually what they put in, the $100 million is interest bearing. So in case they choose to back out of the transaction, they'll get their money back together with a nominal interest amount. And then once the transaction is in place, then the SPAC will go out and identify the target company. Next slide, please. So this slide provides the perspective of the SPAC transaction from the target company side. It's actually not uncommon for the target company to meet with 5 or 6 or even more potential SPAC companies, and then before they nail down to one. One of the most common things that they need to be careful with is actually the audited financial statements. In a lot of cases, these private companies or the target companies, they may have done an audit before, but usually those audits, they were done based on auditing standards in the US rather than based on the PCAOB standard. In order to go through this process, the audited financial statements will have to be done, or the audit will have to be performed based on the PCAOB standard. And then at the same time, attorneys will be involved in helping the companies to draft the legal documentation, the filings, all kinds of agreements. One thing to keep in mind is, in order to make this process smooth, it is very important for target companies, and SPAC companies as well, to form a team of working group, with individuals who are very well experienced and who are knowledgeable about this process. So these are like the auditors, the attorneys, the valuation specialists, the consultants, and firms that could help a company to comply with the requirements after they become a public company, including cybersecurity, including accounting compliance, and things like that. Next slide, please. So the next 2 slides summarize the auditing and filing requirements in a typical SPAC process. So before the merger of the target company and the SPAC company is done, the SPAC company will have to go to the shareholders and ask for approval. And this is usually done through a proxy statement. So either one or 2 things can happen. If the SPAC company doesn't need to raise or register new shares, it will usually just file a proxy statement on Form 14A under the 34 Act. On the other hand, if the SPAC company will have to do a fundraising or register new shares, then it will usually do a combined proxy and registration statement, which is usually done on the Form S4. The filing will be under the 33 Act, which certainly carries a different legal liability profile. And in these documents, it will contain all those information that the shareholders will need in making their decision in approving or disapproving the transaction with the SPAC company. This information will usually include the targeted company's financial statements and the SPAC company's financial statements. These could be historical, audited financial statements, could be interim financial statements, and then the MD&A, management discussion and analysis, pro forma financial information, which is usually prepared under 2 scenarios. First one, assuming no redemption by the public shareholders. The second scenario, assuming the maximum redemption by the public shareholders, i.e. they'll get their money back and back off the transaction. So once the document is filed with the SEC, the SEC will review it, and usually takes about 30 days to provide comments. Process is actually similar to an IPO process. Companies doing an S1. Once the SPAC company, and the target company receive the SEC comments, it will file an amendment with the SEC. The amendment will contain changes to address the comments from the SEC. These could be changes in MD&A, could be additional disclosures, removal of disclosures, or updated financial statements. Because given the passage of time, some of the financial statements, especially the interim financial statements included in the original filing, may become stale dated. So in that case, the filer, the registrant will have to include a more updated stub period financial statements. And then the SEC will review it, and hopefully the SEC will not come back with further comments. And once that's done, then the company could proceed with the close. Next slide, please. So after the transaction is closed, because this is a SPAC transaction, the SPAC company only has 4 business days to file, 8K. The information in 8K is similar to initial registration statement on Form 10. So there are all kinds of items required under the Form 8K, like 201, which is the completion of the acquisition, 401, which is the changes in the registrar's certifying accountants, specifically the auditors. Item 501, the change in control, and then 502, which are the termination or appointment of directors and officers, and obviously the financial statements and exodus. So this is a pretty lengthy document. It's actually quite fun to review this document, which consists of hundreds of pages generally. So that's also the reason why it's called a Super 8K. Throughout this process, one thing to note is for the target companies to comply with the requirements, there's certainly some considerations that they should keep in mind in terms of their financial statements. Number one, what I mentioned earlier, the audit will have to be done under the PCAOB standards. The PCAOB standards generally contain some additional requirements in addition to the US auditing standards. These could be, things like the sampling methodology, additional testing procedures in certain account areas. There's certainly some presumed fraud risks under the PCAOB standards. So, in the accounting profession, what we call this is an upgrade from the US auditing standards to the PCAOB auditing standards. So this is going to take a little bit of time, so you need to plan for that properly. In terms of the financial reporting requirements, the target will have to comply with the public companies reporting, like segment reporting, like earnings per share disclosures, like even income tax footnote. You have to provide rate reconciliations, roll forward of the uncertain tax benefit and things like that. So there are quite a bit of differences that you need to meet. Depending on the filing status of the SPAC, there will be certain relief available as well. If the SPAC is qualified as an emerging growth company, there's certain criteria there, including the market cap, the revenue, and the like. Then the company will not need to comply with 404B or Sarbanes-Oxley Section 404B after it becomes a public company, which is basically the auditor's attestation on the company's internal control over financial reporting. If the SPAC company qualifies as a smaller reporting company, there will be certain relief in terms of the implementation date of new accounting pronouncements. So those are some of the things that target companies should keep in mind. Next slide, please. Next slide summarizes the common accounting issues that I've seen over and over again in these SPAC transactions. The first 2 bullets are kind of related. It's related to the identification of the accounting acquirer. It's not the legal acquirer. The legal acquirer is always the SPAC company. The legal acquirer is always the target company. But from an accounting perspective, who ended up controlling the public company after the transaction, that is going to be critical in determining the accounting acquirer. If the former shareholders of the target end up being in control of the public company after the transaction, then you end up with a reverse recap, which basically requires the financial statements of the public company to be presented in a way that is like a continuation of the target. In other words, the comparative financial statements after the process is done, it will be the target company's historical financial statements rather than the SPAC companies. So there's some nuances there in terms of the accounting. The next one is actually cheap stock, which is a pretty common issue for companies going public, especially private companies. The SEC is certainly very interested over the years in understanding the options and awards granted by the private companies before they go public. They were granted at fair value. So if the private company granted options to employees or other parties at pennies, okay, or below fair market value, you end up with a cheap stock. There's an accounting implication there as well. So this is kind of a commonly seen review comment from the SEC. There's actually a very useful reference available in the market. It is a valuation and financials guide published by the AICPA. It's related to valuation of privately held company equity securities issued as compensation. So you may want to refer to that. That is actually a very, very good reference. The next bullet is on Class A shares. So when a public company went public and raised the $100 million in the previous example, it usually issued Class A shares. And these Class A shares allows the investors to back out the transactions, to ask for the money back in case they don't like the target identified by the SPAC company. So because of that feature, these Class A shares may end up with interesting classification on the balance sheet. It may not necessarily be considered as permanent equity. In some cases, it may end up with mezzanine or even liability accounting. So that is certainly something to watch out for. The second last bullet point there, the warrant. When the public company issues shares to the public shareholders, it usually issue a warrant. These warrants are usually convertible into 1/3 or 1/2 share or common share of the public company. And these warrants, in a lot of cases, they carry some interesting features, which will end up with some interesting accounting as well. So, I mean, warrants are generally convertible into common equity, common shares. So one would think, warrant will likely be equity, but from the accounting perspective, that may not necessarily be the accounting outcomes there. So that's certainly something that, target companies should take a look at, or SPAC companies should take a look at earlier rather than later. And in fact, this is one of the areas that resulted in the number of restatements of the SPAC companies over the past few months. If you do a search on sec.gov, you should be able to find some of those. In those situations, the warrants were previously classified as equity, and then they ended up being restated and reclassified to liability. There's a SEC speech on this matter that was, that came out like 2 months ago now. The last bullet is my favorite, so-called the Up-C structures. This topic is really a fascinating area. It could that topic itself is worth like several hours conversation. So this is what we call the umbrella partnership C Corp structure. This structure is actually mostly seen in case the target company is a partnership or LLC or flow-through entity. And what this structure does is to allow the target company's owners to retain the tax benefit. This is usually achieved through so-called the high voting rights units. And this structure could get really complicated, especially if the target is a company incorporated outside the US in a jurisdiction subject to certain maximum voting rights and things like that. So this could get really, really complex. The accounting is certainly unique as well. I mean, you may end up, under certain situations, you may end up with the Up-C structure being considered as a VIE, variable interest entity, which will also require, interesting accounting. So, whenever you get into that kind of, situations, make sure, you have the conversations, early in the process. So those are the commonly seen accounting issues.
Anthony, before you hand off to Dawn here, interesting stuff, very complicated, and I know you speak from experience with the Up-C structure. But one of the questions that came in was talking a lot about SPACs. You've been talking about the accounting for them. Traditionally in the industry, we've seen a lot of reverse mergers. Can you just quickly give the audience a kind of what are the differences between a traditional reverse merger and a SPAC?
Interesting question. So traditional reverse merger is what we call a shell company. That's been around for a long time. And there's actually another term for that. It's called the backdoor listing. And in fact, in the past, the reverse merger has a negative perception. The market has a negative perception about these reverse mergers. So the real difference between a reverse merger and a SPAC transaction is SPAC transaction is a new company. It's a company that went through the IPO process. It raised money. It has money in the company. Whereas for a reverse merger in the traditional way, it's a shell company. The shell company was involved in some of the business before. It could be mining, could be whatever. So the company actually had operations before. And in fact, the concern there is, what are the hidden liabilities, if any, of the shell company? So, in the past, when you get involved with a reverse merger, there's a lot of due diligence being done on the shell company to make sure, there's really no hidden liabilities or other issues. But in terms of the accounting, interestingly, both they're actually quite similar. It's the same thing, legal acquirer versus accounting acquirer. So the comments that I made earlier, they will still apply.
Thanks, Anthony. Don, I think you're up.
Thank you, Michael, and thank you, Anthony. Welcome, everyone. I'm Don DePascal from Murdoch Martel, and my portion of the presentation is going to focus on some of the common challenges that face companies in the run-up to a SPAC or IPO transaction. And in particular, as a sort of a footnote, this would also include those companies that maybe are going through a fairly detailed audit for the first time as part of that process. In the first slide, the areas that I'm going to talk about are not indicative of a deficiency on the part of the accounting and finance department, but simply the way especially small startup companies evolve. Resources aren't necessarily dedicated to these aspects of the finance and accounting department in the early days, but as you approach a transaction, especially a public transaction, they become much more important. And so it's not unusual for a small company to find itself lacking sufficient technical accounting expertise and SEC reporting expertise in-house. Those are not usually positions you hire for early in the process of building up the department. It's also not unusual for the department to lack sufficiently trained accounting and finance department personnel, systems, practices that will be required and are necessary to sustain this public company cadence. And in my presentation, I think there's two key words to keep in mind. One of them is cadence, and the other one, which I'll get to in a few minutes, is culture. But nevertheless, the department probably lacks the resources and needs to build up the resources for the cadence that's required for timely earnings releases, analyst guidance updates, and of course, the required SEC filings. And those first two areas are areas where Murdoch Martel often is involved in assisting clients in preparing for the upcoming transaction. The third bullet is more of a statement on the company, and that is a lack of sort of company-wide functional support for these same earnings releases and analyst updates, because the company really, as a group, hasn't had to confront these earlier in its development. But these are the type of processes that will be necessary. And this includes the support for the certification processes, which are very important, Section 302 and Section 906 require certifications. Company will often have a sub-certification process and maybe even a disclosure committee to support those particular certifications. Next slide. So I think the other area of challenge, I wouldn't call them, I call them problems, but challenges is probably a better term to use. In the run-up to a SPAC IPO type of transaction is you need to be prepared for life to change, and how will it change? You need to be prepared for due diligence, which is going to be much more robust than you may have experienced in previous financing rounds. And this is something you might expect in terms of a company whose shares are going to be publicly traded. You need to also be more comfortable with the work of professionals that you've employed, especially in legal, tax, and valuation areas. Now, especially for a first-time audit, your auditors are going to pay particular attention to some of the advisors that you've employed and the work that they have provided. And audits often happen around the B or C round of financing. And with the advent of venture debt. But it's not unusual for a company that's approaching an IPO to not have had a thorough kind of upgraded audit that Anthony had referred to earlier. So let's talk about these three areas. So in legal, obviously there's the general corporate matters. I think in the business area, customer contracts are of particular importance, especially since they will underpin your compliance with ASC 606 for revenue recognition and intellectual property. And I think here, my experience has been that it's important to have a good business lawyer to help you with the contracts. And by that, I mean a lawyer who can distinguish between the legal issues, which they have to handle, and the business issues, which they will defer to you, but also will provide some insight into what they've seen in practice that will guide you in negotiating those particular aspects of the contract. Next slide, please. In the tax area, I think that obviously compliance with on-time required filings is important. I think that evaluation of nexus issues has become more important, especially in light of the recent Supreme Court case in the Wayfair matter. I think that even in the early stages of development, a small company can have foreign operations, which are an integral part of its business model. So the evaluation of those structures and agreements and transfer pricing is something that that probably in the early days didn't get as much attention, but needs to be paid attention to now. And I think Anthony also mentioned proper documentation of these uncertain tax positions, which is very important in two particular areas, and that's the Section 382 and 383 limitations, and the viability of your R&D tax credits. I think that the analysis and study of these areas often deferred in the early years, but could be of particular import as you near a public trading transaction. I think that I myself once experienced a change in ownership that was part of the IPO share sale that we didn't pay attention to as quickly as we needed to, and caused some consternation in terms of our ability to utilize NOLs going forward. That IPO transaction is a change of ownership that needs to be taken into account under 382. So, for example, one good reason why these areas are not so important when you're in the startup phase, but more important later. Valuations is very important. I think that especially your 409A to provide a safe harbor for your equity grants. I think that also the work in the 409A will help you to prepare for potential cheap stock questions that the SEC is more than likely going to raise. You can have valuations done for certain derivative instruments, or maybe need to be done. I think the embedded conversion feature in convertible notes is probably the best example of that. And I think that any other valuation work that you've had done by a valuation professional will be could be the subject of additional scrutiny by your auditors. And lastly, you need to upgrade the internal controls as much as possible. In the early days, you rely on your compensatory controls of review and approval because you don't really have the size of staff to achieve segregation of duties. But I think that as you approach becoming a public company, this is something you can look at again, especially to document the controls that you have been relying on, those being the compensatory controls of review and approval. Next slide, please. Now, in conclusion, I would say, and this is where the keyword culture comes in, broadly speaking, this the transaction will bring about a transition in the company's culture from the environment of being a startup, closely held private entity, to one where the shares are going to be traded in the public market. There will be governance that is required, that is strictly defined and enforced by regulators. And the financial and business activities of the company will be followed by sophisticated stock market analysts. So it's a whole different world. It's very exciting, but it's a different world. And I've experienced this myself personally in my previous positions, but also we see this sort of excitement in the transition across our current client practice. Lastly, I would say it's important to make sure you establish the tone at the top, the entity level controls, because these are also important in affecting the cultural change that needs to happen across the company, not just within the finance and accounting department. And this will provide not only the discipline, but also education and understanding around public announcements, the control of information regarding quarterly financial performance, stock trading windows, blackout periods, these type of things. So these are some of the important controls. I think in a later portion of this presentation, Christian will deal with some other control issues. But for now, Michael.
Don, very insightful, brought back some memories here. But a question from the audience. In your experience, what is the #1 challenge that CFOs or controllers face in kind of making this transition from a smaller, startup private company to a public company?
Yeah, so for that, I would say both for the CFO and the controller, it's the cultural transition, because that's important within the finance and accounting department for the controller. But for the CFO, I think it's important across the company, and the CFO's responsibilities, are as an executive officer, are broad across the company, and their success in achieving the transition is very important for the CFO.
Thanks for that. Christian, you're up.
Excellent, thank you. So, we deal with the kind of technology transformation as, clients move from kind of that startup phase to a more mature phase where they are thinking about IPOs and thinking about the technology controls and things that need to be put in place to make that happen smoothly. So some of the struggles that we see with clients kind of go around identity management. That's a big, piece. A lot of the concerns and audit pieces that need to be put into place are around who has access to what, least privileged access, change management, things of that nature. And a lot of that kind of focuses around identity management. So we'll touch on that, as well as endpoint control requirements, vendor risk, are some of the others that are of concern. So when we talk about why identity management is so important, clearly there's a lot around the frameworks that must be followed around kind of the security and integrity of information, financial information specifically, but also of concern is IP information or just privileged data, either within the company or making sure that privileged data isn't shared outside of the company. So getting the proper access controls and managing that and kind of operational controls is very important. What we find a lot of times is that as companies are in kind of that early stage startup, there's a lot of a sprawl of identity. So we end up with companies with dozens of different identity sources for different applications. We'll see clients that have, for example, they'll have individual kind of usernames and passwords for a file sharing program like, Box or Dropbox, for a real-time communication system like Teams or Slack. We'll see financial systems totally independent from each other. And that makes it very difficult to audit and control policies around, password complexity, least privileged access, understanding, access when employees are terminated or leave the company, making sure truly that they don't have any access to all of those applications. So we like to see a single identity as much as possible. So we work with clients who have these issues and are trying to move that direction to kind of rein in all of these different identities into a single identity, which then through a single sign-on or other technologies, that single identity with multi-factor, kind of breach detection capabilities around that identity can then be used to pivot through single sign-on to many other applications. That also helps with lifecycle management, obviously, because as you try to remove access, by moving, users into role-based access groups, or by disabling those accounts, they lose access to all of the applications they should. So kind of getting a hold of this, obviously the earlier the better, right? As as the company grows quickly, it gets harder and harder to unwind that and get things siloed correctly. So, the time to do this is as early as possible. It's going to be less expensive and less problematic to handle it while you're smaller, rather than, when you're larger and pivoting is that much more complex. So, controlling identity, very important. One of the top things that we see that needs to kind of be done right out of the gate. Endpoint management's also very important. Everybody knows the news, the things that are in the news around ransomware, crypto lockers, breaches that are happening all the time. So we see a lot of concern about where the data is, right? You got to have the correct identity to access the data, but data is residual and it can end up on endpoints. And, are those endpoints encrypted? Are there correct policies around those endpoints? Those are all important questions that are difficult to answer in kind of a disparate kind of technology plane, as a lot of startups are, where endpoints are unmanaged. Everyone's kind of using their endpoints. You have Macs, you have PCs. There's no real control. There's no real management. It's very hard to answer a question of, oh, if that laptop is stolen or if it was left somewhere, do we have a reporting requirement? Was there critical data on that, whether it's IP or financial, that we need to deal with? So getting a good handle on all of your endpoints, making sure they're protected, that they are following the compliance, following the policies and procedures that you have in place and that you might have to attest to for insurance or for audits, is another thing that we work with our clients on. And again, the earlier you can kind of catch that and deal with it, the easier, because it's a lot of work to migrate users from an unmanaged system to a managed. It's much easier to onboard new employees and new staff straight into a system that's already set up and running. So that's another big thing that we usually engage with pretty early with clients to make sure they're covered. We can move to the next slide. Lastly, vendor risk management is a very important thing that's on CFOs and compliance managers' minds. Understanding who they should partner with, where they can trust, where they can put critical data. And one of the things that we see a lot is clients not having a good internal security program or policy set up, because any vendor risk management, understanding the risk of vendors and trying to figure out who you can work with and what must be true for you to put your critical data into a third-party location, it really depends on your own security policy and program. And a lot of times, again, as startups are moving quickly, that baseline understanding of what your own security policies, what your own procedure, what your own change management, vendor risk management, all of those policies have to be set up so that you can understand how to evaluate the risk for a supply chain or for critical data or things of that nature. So, really getting that base level policy down, understanding what must be true is kind of the baseline first step, and then having a program where you can understand and it can help inform you what vendors you want to work with and what must be true, what certifications they might need to have or what they might have to attest to in order for you to partner with them to put your critical assets there, is something that we see as a challenge and something that can be worked through, but having that baseline policy is very important. I think that's my last slide. So yeah.
Okay, Christian, before I let you go, a lot of good stuff. I would say as a former CFO, IT controls are one of the things that scared me the most. But you've gone over a lot of things in the last 5-6 minutes or so. I'm going to ask you the same question I asked Dawn, which is, what's the one thing that, in your experience, gives controllers, CFOs, the most heartburn as they transition from a smaller private company to perhaps a more sophisticated public company?
I think for CFOs, understanding the access control is and the identity of who's accessing what data is very important. A lot of the issues that they're trying to solve is segmenting the financial information and understanding who has access, when they have access, being able to audit that and understand that. So getting that sorted and lined out is something that is obviously on people's minds. I would say not necessarily intertwined too much with kind of an IPO or, making that financial information public. I think what's on a lot of people's minds is just the general risk of IT to their operations, right? You can't go a day in the news now without hearing of some major breach or some major, issue, either leaked data or some kind of interruption through ransomware or things of that nature. So I think the CFO and controllers, that's definitely on their mind, and understanding how they can protect themselves, protect their client data is definitely something that keeps everyone up at night. And there's so many facets to that, even to, do you have the right insurance? Is that dialed in correctly? Are there carve-outs that are essentially making your cybersecurity insurance useless because there's so many carve-outs you'll never be able to pull on it? So there's a lot of things, but yeah, I would say understanding kind of identity and control is a big one, and then just general risk assessments, understanding the risk of kind of IT into the systems.
Appreciate that, Christian. Anne, I think you're going to take questions if we have any.
Absolutely. Are there any people out there who haven't posted in the chat that have questions they'd like to get answered? Now is the perfect time. It's okay, don't be shy. We're here to answer your questions. Mary, looks like you have a question. Please go ahead and type it into the chat, Mary. Anthony, question for you. You mentioned choosing the right SPAC. Can you discuss that a bit more?
Choosing the right SPAC is certainly a very, very important, step. And it's not just so much on the, the pricing, the term sheet, the value, but it's also the, the experience, what the SPAC management group could bring to the table after the completion of the process. Say, for example, if the SPAC management group, they have the industry experience, there's a lot of things that they could, bring to the table after the completion of the process. These SPACs, they usually have a term of 2 years. So as they get closer to the end of the term, they're certainly under more pressure to complete a SPAC transaction as well. So, those are certainly factors that are relevant in choosing the right one. But certainly, you want to work with someone, who you feel comfortable with, who could bring value, who could add value to the stockholders after the transaction. So choosing the right SPAC is certainly key. So it's not uncommon for target companies to meet with, I mean, I've seen cases in which they talk to like 7 or 8 SPACs before they finalize one.
Yeah, I would echo what Anthony said. I think one of the things we need to keep in mind is that the merger into a SPAC, the SPAC shareholders don't disappear. Clearly, in most cases, life science companies merging into a SPAC, the target, as Anthony has described it, will control, but those SPAC shareholders are still going to be there. And remember, what we call the sponsors of the SPAC, the people that are starting these entities, are doing it to make money. They're going to keep shares, warrants, options. So as Anthony said, they're going to be part of your either manage a board or at least a shareholder thorn in your side going forward. So I think it's as, it's kind of like dating, right? I mean, you want to make sure that the person you're going to be married to has similar vision. It's not just, hey, look, I need the money, let's go find a SPAC and merge, because those people that started that SPAC did it to make money. And so they're going to be part of the team. And if you want to just know good from bad, there was a Wall Street Journal article on August 4th about some SPAC sponsors that have bad reputations. I would encourage you to go read it. But I think Anthony's answer is on point.
We have a few more questions from folks out in the audience. First one looks like it's for you, Don. What are the key considerations for a SPAC CFO, in your opinion?
Yeah, so I would say, to me, one of the key considerations would be someone who's gone through this process before from a private company, has made the transition. That's probably the paramount requirement, I would say. I think the other usual requirements for a good CFO, in terms of ability to communicate the company's business strategy, financial results, and work with analysts are kind of a given, I think, for any public company CFO. But I think for this type of transaction, it's very helpful if that CFO or close advisor has made the transition. I think that that would serve that person well in the role of a CFO post-transaction.
And it looks like there's another one for you, Don. How should CFOs acquire the knowledge needed for this process? Is self-study appropriate? If so, what resources do you recommend? Full-time hires? If so, what companies should we look to hire from? Or are outside specialists the only way to go?
Yeah, I guess, again, I would say that in this particular area, there's probably no substitute for experience. That's not to say that people coming from other backgrounds couldn't be successful CFOs in this area. But I think that it's if you work with startups, you know that the culture is different and the transition is challenging. So I think, my guess would be if someone wanted to wind up going through this path, I would become a CFO, look to become a CFO at some interesting, dynamic startup and shepherd them through that process all the way through to public. I think that would be, to me, the best way to start to acquire the skills and the experience necessary to succeed.
And it's Anthony here, if I may chime in. I think on the earlier point about the the CFO experience, I think it's critical that the CFO needs to manage the market expectations carefully. I mean, I've seen cases in which companies, the targets, they painted a very rosy picture in terms of the forecast. They went out, they raised a whole bunch of money, but you know what? After they become a public company, before they file a 10K, before they do a 10Q, they do a 8K and announce that the forecast actually got reduced by 30%. And if you Google it, there's actually an example that happened like 2 weeks ago. The market certainly penalized it. I mean, the share price actually dropped significantly because of all this. So I think the CFO having the experience in managing the market expectations is certainly critical. It's not just for a one-time deal. It's actually, this is a long-term thing.
I would just add, I agree with everything Anthony and Don have said. But if you're in a situation where you're going through this process and you don't have the experience that maybe we're suggesting you have, ideal opportunity to find somebody like Don to be a consultant or advisor, because you want to make sure you don't do what Anthony suggests, is you don't want to put a step wrong here. And if you don't have the experience and you're not a seasoned public company CFO, then go find a Don to be one of your advisors and consultants to help you through the process. And I think, part of the question to Don was, well, how can you get that experience? You get it by having people on your team who've done it before, who can help you along the way.
Very good point. And in fact, I think Don kind of mentioned that earlier as well. I mean, during our audit, we also look at the company's experience, one of which is actually the involvement of consultants. Someone like Don who could help the company in preparing, all these 20 pages accounting memo, or someone like Christian who could help companies to identify all these, information technology, general computer controls, cybersecurity disclosures, and the like. Those are certainly relevant factors when we perform the audit as well.
Super. I have another question for the panelists. Do you recommend making forecasts as a public company to provide guidance?
Well, I'm putting on my ex-CFO hat here. The answer is no, no, no. I think, if you're an Amazon or a Google, maybe, but for most companies, making forecasts only leads to one thing, which is I missed it, right? And so I think the general consensus, at least amongst, I think most mid-market, mid-cap CFOs, and Don can jump in here, is that you want to stay away from forecasts if you can. Sometimes you get pressure from your CEO and or your investment banker, but I think the general rule is don't unless you're put in a box. Don, what do you think?
Yeah, I think it's an interesting challenge. I mean, I would agree. You have to be, careful. I think for smaller companies, there's also the challenge that you want to be followed by analysts, and so to some extent, they're going to pressure you for, guidance and outlook that is, maybe more than you would care to give. So I think for the smaller companies, it's a bit of a challenge. I think obviously if you're, a huge market cap company, you can do what you like. So I think you have to balance being careful with giving guidance with the fact that you're probably going to have to give some guidance to encourage followership by the analysts.
In the interest of time, we're kind of running up on the end here. Oh, one more question. How much in expenses should be budgeted to prepare for the process?
So
go ahead,
I'll chime in, and then I'll let the other panelists to provide their thoughts as well. My response is, it depends. It depends on a number of factors. I mean, number one, how ready the company is. I mean, if you look at it, I mean, if the audit were done, okay, based on US GAAP, okay, the incremental expense will be the upgrade to PCAOB standards, okay, versus another company that has not been audited before, okay? The auditors were to go back like 2-3 years and then re-audit everything. So that itself will result in a huge difference. The complexities of the transactions, if you get into an Up-C structure with a foreign entity subject to all kinds of, high voting rights, well, if you just look at the tax provision, if you just look at the, the tax service provider, that itself could be a pretty hefty expense. So it really depends, but my advice is, if there's something of interest, prepare for it sooner rather than later.
Super. We're coming up on the end of our time here. Thank you so much for joining us today. If you have additional questions, we're going to be sending out an email not only with a recording of this event, but contact information in case you'd like to get in touch with any one of our panelists or any of the companies who provided the event today. So thank you very much, and we hope you enjoy the rest of your day. Take care.
Bye.